Hi everyone, welcome to another Learn, Grow, Invest meeting. We're back. So if you notice what's been happening with us, we are kind of trying to break from the last week of every month meetings, and we want to actually bring you more content, more valuable insight in terms of investments. So we're actually trying to ramp up, and this discussion that we're going to have today is just really just a little taste of what's to come. We're planning a lot more content, a lot more tutorials, as much content as we can bring you as an investment community. That's what we want to do. And so before we kick things off, as usual for us, we're going to open with a brief word of prayer. So let me jump right into that. So Lord, we just thank you so much for this day. We thank you, Lord, that everything that we're about to do and discuss as persons who are interested in investments and learning and growing as we become better investors. We pray for your guidance. We pray for your wisdom. Father, we pray that as we seek to become wealthy, that we will not lose the main purpose of why we were created, and that is to give you honor, glory, and praise. In Jesus' name, amen. So, guys, today we have a very, very special guest, a very dear guest to me, Robert from so many different places, but you probably know him mainly from Millennial Investing or the Investors Podcast Network. He's, I'd like to say, a good friend of mine. And we're about to have a discussion as a follow-up to our previous discussion in April that was about a month into the pandemic. So I'm interested to see where he's at in terms of his portfolio, what changes he would have made based on our last discussion. He would have highlighted some key companies that he's watching. So I'm interested to see how those companies are doing. And as usual, if you have questions for him, just post them in the chat. We want you to know, just share this video, share it with your friends, share it with everyone who is interested in investing. And for everyone who's here, let's welcome Robert. Hey, you're on mute, my friend.
Thanks for having me, guys.
Yes. Thanks, Robert, for joining us. So we're just going to jump right into it, right? So in April, we were right about a month in COVID. And, we spoke about a couple of things, but mainly we spoke on, how to have a healthy perspective in terms of your portfolio. You spoke a bit about some of the industries, like the cruise lines, and you spoke about some companies. So the first question I want to jump into is what has really taken place since our conversation in April in terms of your portfolio and your outlook on the stock market?
So for me personally, my portfolio has done very well. I personally joked on Twitter the other day that I've become the best investor that I've ever been in 2020. That's not necessarily because of my returns, although my returns have probably been some of the best that I've ever had, but mostly because I haven't checked my portfolio. Really, I've maybe checked it twice since April, since we last talked. And so the reason for that is because I know I buy good companies that I believe in for the long term. And so I don't need to check on them all the time. And, I'm doing other things. I'm working on building a business and a podcast and a bunch of other different things. So for me, that's really been the biggest key for me. And probably the biggest thing that I've learned is just that I'm able to weather the volatility. And I do have the risk tolerance to go through what we went through, because we did see some stocks fall 40, 50, 60, 70%. And so I think that was a good test for a lot of people. And for me, I learned that I was able to weather that storm, take on that risk, and continue to hold.
So, I actually share a similar sentiment. So right around maybe August there, I realized that, this pandemic is really going to be dragging on. So I actually took the approach to kind of step back, watch how things were shaping up. The companies that I owned as well, I felt pretty comfortable with them. So I didn't make much changes either. I took profit off one company. And actually, if I held it, it probably would have been worth a lot more now. But I thought it best to at least take something back, because when things started to move slowly here, and whereas we didn't have a cure, but we kept on having new cases, I thought it was best to just kind of be a little bit conservative in terms of adding more, but I mostly held the same portfolio that I would have had before. So in terms of, though, I know you said you didn't really make a lot of changes, but has anything changed for you in terms of your perspective on maybe the companies that you hold?
Really, no. I'm a bottom up investor. I really am focused on the companies, and it just so happens that the companies that I like are pretty resistant to what's going on right now anyway. Some of my favorites are Visa, MasterCard, PayPal, Square, and they're still doing well despite the pandemic, and I expect them to continue to do well into the future, kind of regardless of what happens with the pandemic in the short term. And again, I'm investing for 5, 10, 15 years from now. So I'm not really too concerned with what's happened since April, or even what's going to happen over the next year or so. I'm just continuing to buy great companies that I think are at a good value and continue to hold them for the next 5 to 10 years.
Okay. So you're saying that the pandemic has changed nothing about your investment strategy at all?
Not at all.
Well, that's an interesting thing to think about. What I've done, so it changed one thing for me in that I started to look at the business model for some companies, because I anticipate that for some, sales may not be the same, or they may have to close some locations based on what's happening. So that's what went into my decision not to add more. And I was quite comfortable with some of the allocations that I had, but I really, I was one of those persons who started the year thinking that maybe we could be headed for a recession. And then when the pandemic came, it's like it was supposed to possibly lead to one, but again, it's been just drawn out. So it's like what should have maybe happened this year maybe could possibly take place next year or the year after. So I've been just kind of watching to see what developments happen, but it's been happening so slowly that I don't know if it makes sense to make any major changes. But that's interesting to me that you're not changing anything. That's cool. So in terms of the stocks that you're watching, are there any that, based on COVID, that you're thinking maybe if things look a certain way in the next few months, you may take a position in those companies?
Not really, because I don't invest like that. I don't invest saying, okay, we have a major event going on right now, or a macro event that's taking place, and I need to invest based on that. I invest in good companies that I believe in for the long term, and I don't think that that's going to be impacted by a short-term issue. So right now I do have a small position. It's very small in my portfolio, of Southwest, and it's down. But the hospitality industry, travel industries are getting killed right now. But I'm investing in Southwest for 15 years from now. So what is Southwest going to look at in 2035, not 2021? Maybe they are going to get hurt in 2021, maybe even 2022. But by 2030, 2035, which is what I'm looking at, I think COVID is going to be, not forgotten, but it's going to be long in the rearview mirror, and I don't think we're going to have to worry about it. So for me, no, I'm not looking at companies. I think there are people that are buying companies just because they're doing well in Corona, and I personally think that's a short-sighted way to invest. I don't think that. This is going to be a short-term, temporary headwind. There's been many issues like this in the past, and I don't personally think that's a great way to invest.
Okay. Well, so what I thought, so I thought the tech companies would have been a good. So I believe that you can do. So I'm definitely I may be about, let's say, about 80 to 90% of value investor, but I do take the opportunities to trade where possible. So I was looking at the tech companies. I know Microsoft has done since the pandemic. I believe it went as low as, I'm trying to remember the numbers. At one point it was about 150, 160. Now it's maybe 216 at the end of today. So I was looking at the tech companies, the companies that can actually scale and increase their revenues due to the pandemic. So that's what the short term looked like for me, because I wanted to weather the storm for the losses that I may have for some of the companies that I have. Because there are some companies in my portfolio where I'm realizing maybe 20-30% losses, and though that's okay for me if I can get short term gains from another part of my portfolio, I'm definitely going to take advantage of that. So I remember you said in the last discussion we had, you had maybe about 1% of your portfolio in Zoom. So you've held that, you haven't added to that position?
No, so I just, one thing that I want to drill in on what you said is that you invest in tech companies because you think they're going to do well in the pandemic or because of COVID. I invest in tech companies too. I'm looking at my portfolio right now. I have positions in Apple, Datadog, MasterCard, Mercado Libre, PayPal, Shopify, Yext, Microsoft, a bunch of other tech companies, the Trade Desk. So I'm heavily invested in tech, but my thesis isn't because of the pandemic. You said
Okay.
specifically that you're investing in these companies because of the pandemic and you think they'll do well. I'm investing in these companies because I think they're undervalued companies that are going to be great businesses for the next 5 to 10 plus years. Has
Okay.
nothing to do with the pandemic. So that's the shift that I just wanted to mention there. But in terms of Zoom, yes, I do still have a position. I'm looking at it right now. It is up 492%.
Nice.
My cost basis is $67, and it looked like Zoom closed today at about 400. So that's the first time I've looked at this position in months. So I honestly wasn't even sure how well it had done.
Yeah.
But
Well, so I mean, so this is my thought process, and I'm not trying to convince you or anything, but just for the benefit of those watching. So my perspective is, if you have the opportunity to, if you know that the environment presents an opportunity for a stock to do well, I believe that it definitely doesn't hurt you to add to that position, because the environment favors it. It doesn't mean that you're gonna invest only because of the pandemic, but if you have a solid company, like for example, for me, I was invested in Microsoft because I understand that business very well. So I was looking to Microsoft to do well anyways. The pandemic meant that a lot of persons will be using like Microsoft Teams, and so I thought it would just make sense to, instead of maybe investing in like a manufacturing company or maybe another type of business, redirect those funds to Microsoft, because it'll tend to do better now, and then maybe when things kind of level off a bit, I can go to add to the other position. So that kind of mindset is what I'm thinking of, where if you had $100 to invest and you'd have spent maybe $10 on 10 companies, maybe you put $50 on one company because of the environment in the short term, and then maybe 6 months in you assess, or 3 months in you assess, and then you see if you need to split it up otherwise. So that's what I mean. So that kind of strategy allows a certain flexibility, where you don't just ignore the environment. So I'm not saying that you shouldn't invest long term. I'm just saying I think maybe an adaptable approach may suit some investors. That's all. So
it works for a lot of people. I mean, you're absolutely right. That strategy does work for a lot of people. I just don't personally do that. That's all. And I know there are a ton of people that do that. When Carnival Cruise Lines went on, quote unquote, on sale, when they dropped 80%, there's a lot of people that barreled into that company and put a lot of money into it. And then, they traded it for over a month, maybe 2 months, and they did well. But for me, I don't personally invest like that. It's just not how I invest. I don't have time to do that.
yeah.
I personally don't think that I'm smart enough to guess where companies are going over the short term. So I just don't invest like that.
Yeah.
But it can work. It can work for sure.
I know what you mean, because there is that sort of, trading does take a certain amount of time commitment, that depending on what you do and the things that you're responsible for, it may not lend itself to having to do that research, unless you're going to take somebody else's word for it. Then they might be wrong, and then you're stuck holding a stock that you're not comfortable with. So yeah, I got you. So how is the real estate market? How is that side of things?
So it's kind of funny. The real estate market, in my opinion, is doing fantastic. It's not really what I expected,
Yeah.
but it seems very strong. And what I'm going to say is kind of anecdotal because it's just my experience. I haven't really studied trends too much in terms of other parts of the country, but I haven't heard about a lot of issues other than, commercial real estate's obviously struggling given everything that's going on, but residential, which is where I spend pretty much all of my time investing, seems fine. So I'm currently selling a property of mine, and we had it listed for 12 hours for sale, and we had 16 showings scheduled. And then we put a pause, so we didn't allow any of the showings to actually take place for 5 days until after we put the house on the market to allow some demand to build up. And then by the time the showings actually started 4 or 5 days later, we had 30 showings happen successfully in 2 days. Before the showings even happened, we received 2 offers sight unseen on the property, meaning they hadn't even seen the property, and they waived all inspections on the property. So they were buying it as is, sight unseen, and both offers were significantly over asking price. So regardless, or needless to say, I think the market's very strong, at least where I live. Real estate is hyper local. It's very a local business. So where I live could be strong, and across the country and where you are could be much worse. But for me personally, it's very strong right now.
Yeah. So it's actually an interesting thing because we're realizing a similar thing here in Jamaica where so part of what I was hoping for, so it's different when you're a buyer versus a seller. So you're the seller, you for it to do well, you want to be able to, maybe get more than what you're asking. As a buyer, you're hoping to get it for less
But
than
I
now.
am buying right now too. I just bought another property. I sold one, and I'm buying another one.
Yeah. So we're looking for houses here, but we were expecting for it to be different because I do see where properties that were being used for Airbnb, for example, they're not doing as well because of the pandemic. And I was hoping to be able to at least get some more attractive deals from a buying perspective because mortgage rates are more or less the same, the costs for houses are more or less the same. It makes it a little challenging because again, what we spoke about things being slow, what I'm concerned with is if this drags out, then the prices may not change much. And I guess you have to make a decision as a buyer if you're just gonna buy, because I guess as you said, if it's a good value, you buy, because you really can't predict what's gonna happen. But it's the same thing here. So in terms of that strategy though for real estate for you, is it that it remains the same based on what you're seeing?
Yeah, it's this kind of the same as how I approach stocks. Is if the numbers make sense, I'm going to buy it, and I don't really pay too much attention to the global macro trends. And you know what? Maybe someday that's going to come back and bite me, and maybe I'll kick myself and say I should have paid more attention to it. But you know what? I follow Warren Buffett very closely. He's done it for 70 years, and he's rarely focused on macro trends. And so for me, that's kind of how I'm approaching it. I'm analyzing every deal. If the numbers make sense, I'm going to buy it, and if it doesn't, I'm not going to.
Yeah. So for the benefit of those watching who may not understand what you mean by macro trends, so what exactly does that mean for you? What are the things that you don't focus on?
Anything outside of the individual asset that I'm considering. So in the stock market, it's the specific company. So say we're looking at Microsoft. If it's not related to Microsoft, I'm not looking at it. So that's things like interest rates, geopolitical climate. So here in the US, of course, we just had a major election.
Yeah.
Coronavirus, things like that. Those are all macro events that are going to impact these assets, but we don't know how they're going to impact these assets. And in my opinion, there's no way that we could ever know. So for me, we just kind of avoid those and look at what we can know. And so that's by looking at the specific asset that you're looking at. So in the stock market, it's the individual company you're considering buying. In real estate, it's the individual property that you're considering purchasing. So that's really where I focus. I focus on the micro, so which is the asset that you're buying, and not so much on the macro, which are the global trends or events that are occurring that we have no control over.
Okay. So I definitely see some benefit in that. I guess depending on your philosophy in terms of investing, it's definitely a low maintenance approach, just focusing on the asset that you're buying, because I guess what that's saying is that you cut down that time to research and analyze and thinking about the impact of everything that's happening out there. So if you're focusing on macro, then you're thinking about how maybe the rise in interest rates has, as you said, is affecting maybe persons buying power, which is affecting maybe how much they'll have to invest in the software, in this case Microsoft that we're talking about. You're not thinking about that stuff. You're just thinking of things that relate directly to Microsoft. So you're looking at just maybe their reports, any company activity. If it's not labeled Microsoft in the news, you're not watching it.
Pretty much. I mean, I do look at trends in the sense of like, our customers moving away from Microsoft products. AWS got set up, so who's losing cloud customers to Amazon? Things like that I'll pay attention to, but I'm not paying attention to an election or coronavirus or all these different things that we have zero control over that are not related to the individual business or asset.
Okay. So I definitely see so what I do is not quite, so I do think, well, I guess it's that hybrid approach as I would have alluded to earlier, because on some level, what I find is that depending on what is happening in terms of the macro activities, I may say, well, this period may not. I may be better off using my cash to do something else, or maybe direct it in a more purposeful way. Maybe I do some things that aren't directed to the stock market, but it's maybe making money in a different way. So that's how I kind of use it. But I do have any stock that I would buy. I'm not thinking 2035 like you are, but I'm thinking maybe 2025 or 2030. And so the companies that I have, I'm fairly confident that it's gonna hold. Real estate, I'm still trying to get used to it. I think that it's one of those things where, so I think there are certain factors that limit how well a property can do in a certain area. So there's this philosophy that we have locally that once you buy real estate, it has nowhere to go but up. I don't necessarily agree, but I'm fairly inexperienced in that regard. So how would you kind of advise somebody to buy real estate as opposed to buying stocks? Because I mean, is it the same thing? Is it different? What do you say there?
Well, first, I don't think real estate can only go up. I mean, there are markets that I've looked at where prices of houses haven't gone up over 10 years. So for me, I'm a really data-driven guy. I'm an accountant by trade, finance guy, stock investor. So I approach real estate with a similar approach, and I really look at the numbers a lot. And so for me, it's kind of funny. I don't look at macro trends in the stock market, and I don't really when I'm looking at properties, but I do look at demographic trends. So are people moving into the area? Are people moving out of the area? Are jobs, is there more jobs? Is there job growth happening? Are income levels rising? Historically, over the last 10 years, have property values been increasing? And then lastly, how has crime been trending? If crime is trending up, I don't tend to like to invest there. If crime is trending down, then I would consider investing there. But the biggest thing for me is population. If people are leaving the area, price values are going to follow that. Price values are going to go down because it's a supply and demand issue. And if there's if there's supply, the supply is probably not going to change significantly down, which is the only way that the prices could go up with people leaving. And so since that's not going to happen, the supply is going to remain pretty steady, and you're going to see the demand decrease with people moving out of the area, and that's going to cause prices to decline. So for me, population is probably one of the biggest things. I want to see a growing population into where I'm investing.
Okay, so does that mean, for example, if you own a property and crime starts to go up, are you looking to sell, or are you maybe trying to ride out that storm?
It depends. I mean, crime is one of those things. It takes time. So you probably wouldn't notice until it got to a point. I mean, It just takes a while. I don't feel like crime is not going to change. I don't think in general crime is going to change enough in a year or 2 years that you're going to be like, okay, now I need to sell this property. I use it more from the perspective of what markets I'm trying to consider to get into. So when I'm looking, I invest long distance, so I don't invest locally where I live. And so I use this data to try and determine where I'm going to invest. And so if crime has been trending up, then I'm not necessarily going to consider that market, not necessarily so much as a sell signal, but more as a buy signal as to where I should or should not consider investing.
Okay. So where would one, so let's say, for example, that, so since you're buying out of state, I imagine that there may be some requirements different for someone who's trying to purchase internationally, but where can one find that data in terms of the real estate market? So if I wanted to look up properties in a certain state, where can I get that information? Where can I go to get information on properties that I'd want to buy?
So outside of the US, I honestly don't know. But within the US, there's census data from the US government. So they do surveys every year or every couple of years to get census data. And that census data is where you get the data that you need. They publish it publicly on the internet, and there's websites that you can use to look up this data. And one of the ones that I use is called city-data.org. And that's probably my go-to.
Okay. I'll ask one of the moderators to type that in for everyone to see. Okay, so in terms of that kind of process, so buying a new property, you mentioned, looking at the demographic data. You mentioned that resource that you just shared about getting, information on the property. How is it that you determine a fair price for that property?
So if it's a 4-unit or less, a property is valued based on comps, which means it's based on properties that have sold that are similar to that in the area within the last usually 1 to 6 months. So if you're buying or selling a 2-bedroom house with 1 bathroom, they're going to look at all the 2 bedrooms, 1 bathroom houses in the area that have sold in the last few months, and then they're gonna value your house based on that. If you're looking at more than 4 units, so if you're looking at 5 units or up, it's based on a cap rate and on your net operating income. So these are considered commercial properties in the United States, and they are based on a multiple of the net operating income that they produce.
Okay. So what would be, so let's say that someone, and I would have asked you this question before, and because I think it's a relevant one, meaning in our last meeting, how does one get to the point where they are able to acquire their first property?
I still think that the best way to acquire your first property is to house hack. I think that's the best way. And I don't know if that's possible across the globe. I would assume that it is, but I don't know that for sure. But at least here in the US, the best way is to house hack. And for those who don't know, basically all what house hacking is, at its simplest form, means buying a property that has more space than you need and renting out all the additional space. So you could buy a single family house that has 5 bedrooms. Say you only need 1 or 2 of the bedrooms for yourself. You rent out the other 3 or 4 bedrooms. That would be considered a house hack. You could buy a 2-unit, you could buy a 3-unit, you could even buy a 4-unit. You live in one of the units, you rent out all the additional units, and that would also be considered a house hack. But basically, at its simplest form, a house hack just means you buy a property that's bigger than you need, has more space than you need, and you rent out all the additional space to make sure that your mortgage is as cheap as possible for you and allows you to live for free or as close to free as possible.
Okay. And at what point do you try for another property?
Really, once you have the money again. I mean, it's really up to you, right? I mean, it depends if you're comfortable with, if you like it. They call it like a test run of being a landlord, because you get to be a landlord, or so I've heard some people call it landlord light, meaning, it's the light version of being a landlord. And so, I mean, it really depends on the person. So you could house hack and realize you hate being a landlord and you don't like owning real estate. You'd rather just stick in the stock market. In that case, you don't buy another property ever. Or at least not for a long time, or you just let somebody else do it and you give your money to a fund or invest in a syndication or something like that.
Yeah.
If you house hack and you like it, then you buy your next property as soon as you can. You know, you have to live in the property for a year here in the US before you can move out. So you probably have to do it after at least a year. But basically, as soon as you're comfortable with the whole process and as soon as you have enough money to do so, you could go ahead and buy your next property.
Okay. Okay. Well, definitely being a landlord is different. You really have to see. I guess just like with investing, you have to see whether or not you have the temperament for it, what type of risk or situations you like to deal with, and know that in some cases, living with your tenant may present, a certain dynamic that maybe you're not comfortable with. So that trial run is definitely worth it, I think. So in terms of, well, I wanted to ask you as well. So in terms of just since our last meeting, what's the most interesting thing maybe about the market that you've seen, whether real estate or stock, that you wanted to comment on? What's the most interesting thing for you?
The most interesting thing has just been how resilient the stock market has been. I mean, we saw it decline rapidly in March,
Yeah.
and it's back to where it was and significantly surpassed that. Other than that, I just really haven't followed the markets that closely. Not that I still study them, but I just haven't followed the news that much. I'm more reading the books and things like that about strategy than I am focusing on where the stock market is going day over day. I think it's super interesting what's happening in the commercial real estate space. I think that's not really that interesting because, I mean, it's kind of a given. We could kind of expect that was going to happen. So I think really just the surprising thing is how some companies are faring during this and how they've bounced back so much. Like I said, I own a position in Southwest. I bought it towards the bottom of the crash, and I did that not because I wanted to short-term trade it, but I've been wanting to buy Southwest. I didn't think there was a good value for a while. And then with the decline, I thought there was. And so I entered a position, and I've been negative ever since on that one position. It's the only negative position in my portfolio, but I just looked and it's only down 1%. And if you told me in March that an airline company was only going to be down 1% from where it was at March, which was most likely, and don't quote me on this, but probably an all-time high or pretty close to it, and it's only down 1%, that's incredible. And so to me, that's been the most interesting part of this whole situation.
I found that equally interesting as well, because I wonder, so before COVID, stocks just seemingly have been going to all-time highs. And so that's why most persons were kind of waiting to see, how the market would have responded in 2020. COVID comes now. There are some companies that seem to not be able to do as well, but for the most part, people seem as optimistic as ever based on how they're buying, which is I'm absolutely curious as to see how this will turn out as well, because I don't know what's gonna happen. I don't
Nobody
know.
does. Nobody does, and that's the best part about investing.
Yeah, because it we see this thing where a catalyst would happen. Maybe there's a sell down for a day or two, maybe a week at most, and then it's like nothing happened. So those persons who are trading, for example, if you're a good trader, you're probably benefiting, riding that wave. If you're a long-term investor, you're still really not doing that bad, depending on how your portfolio was set up. If you're appropriately diversified, you would have had maybe 10 to 20%, in some cases, as you said, less. So it's really very interesting that the market is pretty much holding up, I would say, because it's like, based on, if you take away COVID, the market position in general, you probably would never know that there's a pandemic. It's kind of interesting that that's happening, which I wonder if persons are smarter, so they're not as reactive, or persons are not are not taking the right caution. Like, I really don't know which it is, because persons are either being really smart or they're not being smart. I don't know which. And I say that because it's interesting for me to see even where, and I know we didn't plan to speak about this one, but to see where the crypto markets are at. Bitcoin is pretty much back to where it was in 2017, and that's just interesting to me that it's almost like the only thing that's behaving as you would expect is Bitcoin, and everything else is happening the way that you don't expect. But we're not gonna go there because I don't think I don't remember what you had mentioned about cryptocurrency. I know Preston is talking about it weekly, but I don't know where you are in terms of cryptocurrencies. What's your take on that?
My opinion on cryptocurrencies is that I don't really have one. I mean, I obviously know Preston well, and I chat frequently, and I'm lucky enough through the podcast to speak to some of the greatest minds in crypto, and so I've been able to have some really great conversations about it. I understand the financial and monetary, fiscal, economic impacts of what Bitcoin can provide and what it's looking to solve. I get that. I don't understand the technology behind it. I don't think I'm ever going to. That's not how my brain works, and that's without my circle of competence. So I don't think I'm going to try and ever understand it from that perspective. But kind of how I'm approaching it is, there's a lot of really smart people that I respect that believe in it. There are some smart people that I respect that don't believe in it. And so for me, how I think about it is, I think to myself, I take some time and I really do some self-reflection, and I say, okay, if Bitcoin goes up and I don't own a position, am I going to be more mad that I missed out on the train? Or would I be more mad if I did buy some and I lost the money? Which would make me more mad, or which would bother me more? And for me, I'd rather lose a little bit of money than miss out on the upside. So what I did is I allocated 1% of my portfolio. I said, if this goes up as much as these guys think it's going to, all I need is 1%, and I'll do very well. If it goes to zero, I mean, that will suck, but it's only 1% of my portfolio, and it is what it is. So for me, I don't really track it that much. I don't really study it that much. I'm not really super concerned with it. I just put a small portion of my portfolio, so I have a little bit of allocation to it, a little bit of skin in the game, and just kind of let it ride and see what happens.
Yeah. So again, that concept of just diversification, it's there. If it does, so there's no one stock in your portfolio that will break you, pretty much, is what you're saying.
Stock wise, there is. Cryptocurrency wise, there's not. I'm not a very diversified investor at all. I run a very concentrated portfolio.
Yeah.
I wouldn't say that Bitcoin was even a diversification play. It was just it was more of a play. Like, I want to have some skin in the game because I want to be able to take advantage of some upside if there is any, but I don't want to have so much skin in the game that if it goes to zero, then I lose so much that it hurts. So I just wanted to be at least a little bit involved. Now, when my stock portfolio, it's very different. I do not diversify very much. I do have a decent number of picks, but when you look at the amount of my portfolio, I have like 85 to 90% of my portfolio in 5 companies. Yeah. So I wouldn't really say that's very diversified.
Yeah, I understand what you mean, because 50% of my portfolio is in one stock.
And yeah, I think my most is 30.
Yeah, and then I have a couple of stocks that are like 10%, no, like 5%. I have like 5 stocks at 5%, so that's about 75%. And then I have about 5 or 6 more. No, it's worse than that. I have there's one stock that's 50, and then the rest are kind of negligible. So really avoid it whether or not I should actually shift that. But I really stick to what I know. So the one stock that I'm holding that much in, I know it well. If there's anything that should happen, I'll get a pretty good idea before it would get to the public. So I'll know, whether or not I need to adjust my position early. And it pays me healthy, dividends where, I'm comfortable with what's there. It's just that it sometimes makes me wonder whether or not that's the best strategy. But I mean, so far so good, I guess. I a few years back I was more active in cryptocurrencies, but internationally it's not the same as it is in the US. It was very hard for us here in Jamaica to get access to our funds if we were to sell. There was a big thing about it back when I first started. So that made me shy away from, actively trading, even though I understood the market well enough. I saw it as a trading play more than an investment play, meaning for long term, because the markets are so volatile where it was excellent for trading. But it's they're kind of changing their tune to it now. So we've heard the stock exchange mentioned that they're gonna be facilitating cryptocurrency. Well, they said that 2 years ago. We're still waiting for it here, but it's just really hard because of the fees. Fees make it really cumbersome to acquire and to actively trade. So I thought it best to just hold a portfolio. I'm thinking again, 5 to 10 years, and then I'll see where it's at. But it's an amount where it's about 1%. No, not, yeah, 1%. No, maybe 4% of my overall portfolio. So again, that's still not that much. Where if it should go down to zero, I'm okay. But if it goes up, I'm still down actually from from 2017. And that's an interesting story that we'll probably share offline. I'll tell you about that. But we did have some questions from our community. So I'm going to start with the real estate market, because I think most of our community will want to hear about the stock market. So we'll close with that one. But first question for you from our community was what states are currently the most favorable in terms of the real estate market?
It depends what you mean by favorable. Some people invest depending on cash flow, meaning how much profit each month the properties will make. Some people will invest mostly for appreciation, and generally you don't find markets that have a lot of appreciation and a lot of cash flow. So generally you want to look for cash flow states in the middle of the US, and that's the Midwest generally. If you're looking for appreciation, then you technically or generally want to be on the coast, East or West Coast generally.
Okay. Well, I guess in terms of favorable, it's probably from the mindset of, I guess, profit, because favorable, yeah, you're right. It would be depending on where the person was asking the question from the base. Okay, all right. So in terms of property type, so state was one thing, but in terms of property type, what would be, I guess, same phrasing, favorable, what type of property? Answer it from two perspectives. Let's say favorably in terms of a first unit, and I know you touched a little bit on that, but favorable, let's say that I'm looking to have maybe multiple transactions over maybe a 1 year period. Which type of property would suit that sort of active buying and selling?
I would look for residential properties that are less than 4 units. I mean, you could go more than that as well, but I wouldn't be touching anything in the commercial real estate space right now. And so pretty much anything that's not in commercial real estate or Airbnb, so these short-term rentals, I wouldn't touch right now. But residential, like houses or even small apartment buildings, I think those are going to do very well, because people need places to live, and especially if you're in a suburb or an non-urban market. So you're a lot of people are fleeing the cities now to go to areas that are less dense, where there's less people. And I think you're going to see a lot of properties, small residential properties in those areas, do really well.
Okay. All right. So next question was about REITs. So before you respond, I'll ask you what is a REIT, first thing, for those who don't know, and are they a favorable option in the US market?
Yeah, they can be. I don't personally invest in REITs, not because I don't like REITs. I do like REITs a lot, actually. The reason I don't invest in them is because I have enough exposure to real estate through my own personal real estate holdings. So through my own rental properties, I own enough real estate to satisfy my allocation. If I chose to invest in REITs as well in the stock market, then when you look at my portfolio as a whole, I would be overweighted towards real estate. So I tend not to invest in REITs. What I would caution people to consider if they are considering REITs is to see what the REITs exposure is to commercial real estate. So mall space and office buildings and things like that, I think you're gonna be struggling. I think a lot of REITs are gonna be in trouble because of that. If you find some REITs that might be in the healthcare space that invest in hospitals or elderly home, things like that, those might be doing very well right now. Again, I don't invest like that, so I don't know for sure. But if I was looking at a REIT, I would look at REITs with apartment buildings, residential real estate, or specialty real estate that's not commercial, not related to schools. There's some REITs that are related to student housing. I would avoid anything that's related or being impacted negatively by the coronavirus and focus on things that are long term going to do well, like residential real estate.
Okay. So pretty much you're saying look at the underlying REIT, see how it is made up, and then make that determination from there as to whether or not you're going to be investing in it.
Yes. Yep.
Okay. It's interesting that you said it that way, because on one hand you're saying you're not looking at the macro, but then you just say pay attention to those that may be impacted by COVID, or is that just best practice for those who may be new to the game?
New to the game, but I also think that when you're investing in a REIT, you're putting your money into a fund and you're expecting somebody else to manage it with an asset that's struggling. If you're investing yourself and you're making your own investment decisions, that's different than giving it to somebody else to invest, because you're making your own decisions and you can avoid certain things and you have no control over what they're buying. And so for me, again, I'm not looking at trends. I thought commercial real estate was going to be in trouble anyway because of before coronavirus, because of people working from home, things of that nature. Technology is making it easier than ever for people to work from home. And this is all pre-COVID. I don't think commercial real estate was as dire as it is today, but I wasn't a big fan of commercial real estate. And I certainly wasn't a fan of malls, physical retail. So those are the types of things that I was avoiding anyway because of before COVID. So it kind of just, not really a trend follow, but it kind of just fits in there.
Yeah, interestingly enough, on that point, what I noticed is that the things that you were expecting, so when they would speak about technology and working from home, in my mind, pre-COVID, I was thinking, okay, 5 years, 10 years, that has been sped up to now. And that sort of breakdown in the market that we were expecting, that collapse, that slowed down. So one thing sped up, 5-10 years, and another kind of is still taking forever. So that's quite interesting, because I do think, so we have this kind of strategy that I noticed in Jamaica, where some companies have not fully embraced working from home. So they have employees coming in, and then if there's a case, if there's a COVID case, then everybody has to be sent home, which to me doesn't make sense. That's not a sustainable model, because they're ignoring putting in the infrastructure that they will need to manage their business. Now, when they have to send home everybody, that business suffers, because now the processes aren't really, making sense, or it's not conducive to persons working from home. So, and I still see some real estate properties being put up, some commercial spaces where the rates are still the same. And I wonder if these persons understand that they're not going to be able to pay rent or pay their mortgage very soon. And I thought, as you said, those rates were pretty much too much. So before COVID, I thought running a business from home makes sense. I thought, having a model that can scale easily without having a property makes sense, because, a few years back, I used to rent commercial property for a company that I owned. And that was maybe, that expense next to salaries were, very close in terms of the highest amount of expense I had as a business. And it choked us out in terms of profit. So we weren't able to make any money because of the rent we were paying and the amount of staff that we had. Being able to pay salaries, being able to pay overheads was just too much. And I've always thought that properties were renting for way more than they should have. especially for small businesses. So yeah, I say all of that to say that I agree with you in terms of that perspective in terms of commercial real estate, definitely. All right, so we have just a few more questions. So recently for us, so typically if a person wanted to buy stocks on the US market from Jamaica, for example, we would use an app called eToro. I found out that was recently blocked for us. I don't know if that has changed because again, my portfolio has pretty much been the same. But someone wanted to know, what are their options for purchasing maybe out of the US into the US, or maybe how can a person trade internationally? I'm not sure if you can speak on that.
I can't speak to it a lot. I could give a little bit of context. I can't speak to investing outside the US into the US. I live here in the US, so I don't have experience doing that, of course. I have invested outside of the US through my brokerage account, through Fidelity. They're one of the largest stock brokerage houses in the US. So I just use them. They allow me to trade on the Hong Kong Stock Exchange and other exchanges as well. And that's how I've done it in the past. I don't know if there's anything like that, any brokerages in Jamaica that would allow you to invest in the US or other countries. But here in the US, you just apply for that through your brokerage and they allow you to do it.
Okay, we do have some here, but yeah, it's there. It's not a large amount of them. Meaning the ones that I know of, I think in general, it's probably more in terms of fees, a little bit more flexible to would have purchased through an app like eToro. But I do know that some more and more brokerage firms are offering the service, so I'm probably not as updated as I should be on it. But I do know that there are a few that offer it, and yeah, I think most persons just kind of prefer to be able to have their own flexibility, put some funds on a credit card, purchase. I did hear about a company called Interactive Brokers. I took the process to get set up on the app, but there was one thing that I needed to do. So it allowed me to set up my account through the app, but I needed to authenticate. There was something that it needed to do. I'll try and post it in the chat after this video is done, but there's one step that I needed to do, but I was able to set up the account. It's called Interactive Brokers. That's the name of it. It does have an app that you can download, go through the process. You will need to share ID, proof of address, standard stuff, and you'll need to have an account though that they can, kind of debit to confirm that you are who you say you are. And then, yeah, so Interactive Brokers is how I would answer that question for that person who asked. So yeah, I do have a Fidelity account, but because I don't have a social security number, I can't trade with what's in my account. So I have some stocks there, but it's through a source that I didn't control. So it's there so I can sell, but I can't buy, which makes no sense to me because I have the account with you. I should be able to sell that and then just manage the account, but they have this policy when I call their support that I can't trade because I don't have a social security number. That was one of those things that I was hoping that would change with COVID, because people sometimes have to go through means that are more costly to do the same thing if a company would just allow you to trade the stock. You know what I mean? Like it doesn't make sense to me for agencies to do that. The truth is, I know for tax purposes, because I know there is well, I don't remember the term right now, but I know there's a tax that you pay when you sell your stocks, right?
Yeah, capital gains tax.
Yes, that's the word I'm looking for. So I mean, apart from that tax can be collected whether or not I have a social security number or not. I'm not sure why that would be there. The next question that's there for you, Robert, is this concept of shorting a stock. What is it? How would you successfully do it? And do you think it's a good idea to short a stock?
That is a very big question, and we could talk about that for an hour in and of itself. I'll try to give a brief overview of what shorting is, and I'll kind of give my thoughts on shorting. So what shorting is basically you're betting against the stock. Is basically in its simplest form. That's what it is you basically, when you go long a stock, you're betting that the stock is going to go up in value and you'll make money if it appreciates in value. When you're shorting a stock, that means you're betting that the stock is going to go down and you're going to make money that way. That's the simple way. That's the theoretical way of how it works. Technically, what happens is you short a stock and your brokerage will go and take that stock from somebody else. They'll borrow it from somebody else and they'll sell it on the market. And then you'll get those proceeds. And then at a later date, what you have to do is you have to buy that stock back at the market price and then instantly sell it and give those shares back to the person that you borrowed it from. And so that can get a little bit confusing, but that's how it works. That's how the brokerage does it. They do that all behind the scenes for you. You just say you're going to short it on your computer screen and they'll take care of all that for you. But that's the process. That's how it works. Theoretically, that's what's going on. Now, my opinion on it, theoretically, I love shorting. I've never actually done it though. So in theory, I love it. In theory, I love it. In practice, I'm scared of it. And the reason of that is because with shorting, there's unlimited risk and capped potential. With going long, it's unlimited potential with capped risk. So with shorting, the most that you could ever make with a short, no matter what, is 100%. So if you bought a company and you shorted it and it went to zero, it went bankrupt, the most money that you could ever make is 100%. However, if you short a company and the stock goes against you, meaning the value of the price of the stock goes up, you have unlimited risk because that stock technically could go to infinity. So while you can only make 100% on the downside, we've seen Zoom go up, like I just said, 500%. If that stock went up 500%, you could be down 500%, which what that means is you're down 5 times what you put into that money. So you're, instead of being up 5 times, think about what that does on the downside. You're down 5 times. So if you put in $100, you would be down $500. So you can lose more than you put in. And so it's very risky from that perspective. So that's what it means is there's capped potential, meaning the most you can make is 100%. There's unlimited risk, meaning you could lose way more than you put into the position. On the long side, it's the exact opposite. If you invest in a company, the most you could ever lose is what you put into the company. You can never lose more than 100%. That's the most you could ever lose. But on the upside, you could technically earn thousands of percent, right? Zoom is up 500%. People that bought Amazon are up 20,000%. So the potential that you could earn is unlimited on the upside, but very capped on the downside. So shorting can be very, very, very risky. It can be good for the short term, but it's a very risky strategy. And so for that reason, I tend to stay away from it.
Okay. Yeah, I think I've seen a few persons locally ask for, the local stock exchange to start shorting stocks. And I think that's because they feel like they can take advantage of the emotion of the market. If something doesn't do favorable, or if somebody, in a certain position starts to speak a certain way about the stock, then they see an opportunity to short it because they may be able to predict that it's going to trend down for a little bit, and then they'd sell it and, recover or make profit in that way. We always, well, not we always, but there are times when persons focus a lot on the upside and not on the downside. So that's definitely an interesting take on shorting. I've never heard it explained that way. It's actually quite an interesting take on it, as Chike is saying in the chat. And so just 2 more questions for you. In terms of, there was news about a vaccine the other day. There's actually multiple, but there was one specifically that came out, I think, last week. About so the question is phrased: do you think that the downward trend that's happening to some of the tech stocks based on the vaccine news, do you think that's just kind of short term? What is, I know you're not used to thinking in 1 to 3 month block. But what do you think
You
will
know what
happen?
I'm gonna say, Jermaine. You know what I'm gonna say.
Yeah, yeah, yeah. Um,
I don't invest like that. I honestly I don't have a good answer for you because I don't invest like that. Um, some of the companies that are being hit the last couple of weeks are down a couple, 20%, but I'm up 500%. So 20% is not a big deal to me. I'm investing for the next 10 years. I'm not worried about what's happening with the vaccine over the next 6 months.
well, so let me phrase it this way then. Do you think it's a good time to enter a position in a tech company? As you said, it's up 500% this year alone. Should you buy a tech stock right now?
Depends on the company.
Okay.
Depends on the valuation, depends on the company, depends on your prospects for the company. It depends how you feel about the company. I mean, there's is it a good time to buy Zoom? Probably not. That's my opinion. I could be wrong. It could go up 500% from here. Maybe it's a great time. I don't know. Is it a good time to buy a different company? Maybe. Again, I don't know. It's depends on the valuation. It depends on the prospects of the company, and you just have to do your analysis on every single company.
Yes, Chike. Chike is saying that you're investing the Buffett way. You
Very
know,
much so.
yeah, yeah. So I mean, it's interesting. I do agree to some extent. I do think that. So one, I do think that the market is made very interesting with the dynamic that it presents, right? So for me, it's like a sort of this movie I'm watching to see how persons react to news, and then this one is up this week, it's down next week. I think it's all very interesting to see just the emotion and such sort of how do you say it? It's I like how the markets can sometimes be predictable but so unpredictable. So that's all fun for me. So I find it very interesting when persons make certain decisions in the short term, not thinking about the long term. And I think sometimes persons are focused too long term and not see the opportunities to make money in the short term, because ultimately to me you're investing to make money. So you put yourself in the best position to make money, because on the one hand, if you're thinking long term, which is great, as I do as well, I don't know if I'm going to be able to make the same money 3 years from now that I'm making now. So I try to make the best decision for now, and hopefully it remains the same 3 years from now, but I don't know. So I invest from the perspective that if I don't if my income is half, you know next year what it was this year, what would I buy? How would I use the money that I have now? And so I try to have a balance of both short term and long term at the same time, because and that's probably because of my age, Robert. We speak about this all the time. You're looking at it from a different perspective. You're a little bit younger than I am. And so you're thinking 20, 30 years from now, but I'm thinking 15 years from now, 10 to 15 really. So I think that's why it's maybe a little bit different for me. I'm thinking about investing in a way that I don't have to. Well, I think we share that part where we're investing not to kind of monitor it a lot, but to make smart decisions. But I really do believe in maximizing short-term gain as well if you can. So I'm not going to. I always think that if for some reason the market can't function for a week or for 2 weeks, we don't know. The more we become digital, I think there's a sort of risk that's presented that maybe we're not foreseeing right now. So let's say for some reason we can't access the markets for a week. That's a very interesting situation. So I have to think short term in the sense that let me see how much I can take off the table now while I can, but then I definitely see value in focusing long term as well. So yeah, it's really for the investor to choose. If you're watching this, make the best decision based on the information that you have, but be sure to get a certain amount of information where you can make, practical decision. And that's, everything that Robert has really alluded to. It may sound weird for some persons to hear Robert say it depends for almost every question that we've covered so far. And it really does depend, because you can't say one response to every question, because it may be different based on your unique situation. So I definitely agree with Robert for all his responses, though my priorities and decisions may be different. Oh, I think I actually missed a question. So final question for you, Robert, because I'm not seeing any in the chat. So this is the final question. Well, two questions actually. So the first one is, outside of the tech and pharmaceutical industry, which areas do you think are good areas to invest in? I'm not gonna say the time period, because you're not gonna focus short term. So yeah, which area should persons be looking at? So you'd have mentioned MasterCard before, and I imagine that you're still bullish on them, but where else would you be looking at right now?
Fintech is my favorite. Fintech is where I'm focusing. This is not investing advice. Everybody do your own due diligence, but for me personally, 80% of my portfolio is in fintech.
Okay. So what are some of the fintech companies? If persons aren't, we always assume that somebody watching may not know anything that we're talking about. So what's fintech? How would you categorize a fintech company?
Square, PayPal, Visa, MasterCard, Green Dot.
Okay.
Those companies. So it's the intersection of finance and technology. The companies that are doing things like that.
Okay. Yeah, I think that's an interesting space to watch, because I see where we're definitely going to be taking more transactions digitally, and so there's definitely more room to grow for those spaces. I wish we had the same access that you have in the States to some of those companies, because in terms of investing overall, there's a lot more that you have access to in the US than we do from this side. And a lot of persons just aren't experienced, or maybe because of the fees, it's maybe not as conducive to. So there's a currency. So the US dollar is 150 to 1 in terms of exchange rate for us. So if I wanted to buy, so one Amazon stock is probably what some persons make in a few months. So, if somebody wanted to own one Amazon stock, it's not as easy to purchase. And so that challenge kind of presents a unique situation for us. So we have to, I guess, work with mostly local companies until we get to a certain point. So for example, with Microsoft stock, I had to buy, single digit units at a time until I was able to build up, over a few years. So that, presents an interesting thing for us here. So in terms of final thoughts, Robert, on the market, on investing, best practices, is there anything that you recommend as a new investor? So let's say that somebody's brand new to investing, where would you have them focus, or what would your advice be going into the end of the year and into 2021?
In the stock market, invest long-term, don't day trade, don't short-term trade, and in real estate, try and house hack as soon as you can. Those would be my two biggest pieces of advice.
Yeah. Okay. Well, definitely we're going to, as best as our schedule might allow, I think it works out that way, maybe speak, every 4 to 6 months. Because I'm very interested to see that strategy of not looking at the macro trends, how that will work out for you, in the long term. As Ichike is asking about, if you're ignoring the noise around the medical companies and strictly focusing on fintech.
Yes, I would personally never invest in a company based on any sort of speculation of a vaccine or anything like that, I would personally never invest like that.
Okay. Okay. Okay.
People make money like that. It's just not how I invest.
Yeah. I got you. So I would, to answer that question from my side, and it depends. So I look at the price. I look at potential for profit. So if a company if its fair value is determined to be $200 and it's now, 100, I'll buy that. If it's $80, I'll buy that. Especially if now you add the environment and the macro conditions to make it sort of like a perfect cocktail for it to grow. It's not guaranteed. Nothing is guaranteed in terms of investing. I want to leave that with you. Definitely don't think that it's gonna be, you have to, because as much as you may have news that favor the stock going up, there may be news that you're not aware of tomorrow that could change that same stock that you just bought, the outlook for it. So we would just want to leave that with you. Robert, thank you so much. I really do appreciate the time. I was hoping that we'd get some questions from the group. I wanted to do a shout out to those guys. It's been a while since I've been active there, but if you're unfamiliar, can you just say Robert, how persons can contact you? Tell us a little bit about the Facebook group that you have. It's a pretty great group to be a part of if you're not a member.
Well, I appreciate that. So we have a couple different things. I have 2 podcasts. One is called Millennial Investing. One is called Real Estate Investing. Those are probably the best places to find me. On social media, Instagram, Twitter is where I'm most active. And then we also have a Facebook group that has 1,500 or so people in it. Lots of great conversations happening with people, and happy to connect with anybody that would like to chat.
Yeah, I can attest to that, Robert. It's very easy to engage. You'll always respond. As very shocked, Robert, when we first met, how quick you were to respond to me reaching out. I'm glad that we're able to connect, and yeah, I've learned a lot from just following you on social media. So Robert is on IG, Twitter, Facebook. Definitely follow him if you haven't done so. His links are in the description directly below this video. So yeah, thank you, Robert. I'll see you in a few months, right?
Thank you so much.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on our next podcast episode and new investing resources. What are your takeaways and thoughts about this discussion? Let us know in the comments section below.